we're going to start off with what's the fixed rate or what's a fixed loan and an ARM loan, ARM, ARM, and what does that mean?
So ARM is an acronym for adjustable rate mortgage. They were really, really popular in like the 90s, somewhat in the 80s. I felt like they kind of made a strong comeback in the early 2000s, and then they went away, and then they came back around the recession, the Great Recession. 2009, coming out of the recession, 2009 till about 2011, they made a comeback. And those were a longer fixed hybrid ARM. So hybrid meaning that they're fixed for the first portion of the loan and then they can later adjust. And that has been something that we had recently seen prior to the United States and the Iran battle and some of the economic shifts that we have endured. Mm-hmm. We were seeing some of these hybrid ARMs in the 4s. Right now they're in the 5s. If things could kind of revert back to where they were in February, which was such a great time, then I think that we could get back to where we could see some hybrid ARM products in the 4s. That was kind of a hack for me the beginning part of this year. I was locking it all the way up until about mid-March, and then, the United States and the Iran thing began exactly on March 1st, and it just started to kind of fade out after that. But I am starting to, as of actually today, we are starting to see some hope for that to end and hope to see everything shift back with where we were at interest rates wise.
So it's a up and down thing we have throughout our careers with rates and everything. So fixed, you got a 30-year or 15-year fix. It's one single rate throughout the life of the loan. The 7-year ARMs, the first 7 years, you're going to get them a lower rate than what we have right now as far as what do they call the national average. And then after 7 years, it will go up into whatever the rate is at that time. Is that correct?
Yeah, on conventional, it's most common to have it fixed for 5 or 7 years. And if it's on an FHA loan, it's most common to have it fixed for 3 or 5 years if it is a hybrid ARM.
And then the thinking is if rates adjust in that 3 to 5 to 7 year period, you refi into a lower rate, and then you get the permanent lower rate instead of waiting until the 7 years or whatever it is, and hoping it's a lower rate.
Well, I mean, historically speaking, people usually were staying in homes anywhere from 3 to 5 years, usually in Utah, and then moving just on average. Right now, we're, depending on the data that I read, we're somewhere between like 9 and 12 years because of what has happened with interest rates. Mm-hmm. But now that is even starting to mix up a little bit. And I think it is some of these products, the temporary buy downs, the fixed and versus the hybrid ARM coming out. I think that investors are becoming really aware that there needs to be more options to kind of hack affordability, which is what the hybrid ARM and the temporary buy down create.
And I've told my clients about the 7-year ARMs, and the one question I get the most is, well, after 7 years, what if the rate's too high? I'm stuck now. So I know what I tell my clients, but what would you say to someone that's, if 7 years goes by and I haven't gotten into the new rate, which I don't know why you should be able to by then, but if to answer our buyers' questions, if there's 7 years and the rates just went up, now what? I'm stuck with a higher payment now.
Well, depending on the loan product that they're on and what the parameters are, they typically, when they get to the end of the fixed period, they typically can only adjust 1 or 2%. So if you're already at, say, 1.5% below current market at the time that you closed on your loan, then at the end of the 3, 5, 7, or 10-year period, that in advance, that you're going to be going up 1% to usually max 2% in the initial adjustment. I mean, the other side of it is there are options where, say that the market doesn't shift and you need some kind of relief. You're not able to afford your payment. You could sell. You could talk to your loan servicer about doing a loan modification, saying like, look, I'm not going to be able to afford this ARM. I thought things were going to go one way. Now they're going another. For a long time after the recession, we were doing a ton of HARPs and HAMPs in the industry. Those acronyms are Home Affordable Refinance Programs and Home Affordable Modification Programs. And that's where lenders are enabled to come in and create an environment of affordability and safety for consumers. And coming out of the recession, there's more consumer protection laws to make sure that people can kind of pivot with their loan, if that makes sense, and not get in a position where they feel hopeless.
And that's why I bring you in here, because you actually came up with answers I didn't even know, which is great. And I love that. That's great. My answer was, well, you can always sell your home and you can cash out your equity on it, and because you will build the equity within the 7-year period. But then you've got all these other options as well. So again, if you're unsure about these things, you want to talk to Emily. She has all the answers. 29 years of doing this, and she's seen it all and done it all. So love it, love it, love it. So let's move on to some other programs.